Turbulent, competitive, and compelling. Electric vehicle maker NIO Incorporated will report its financial results for the first quarter of 2024 on June 6th before the market opens. Analysts predict a loss of 31 cents per share for the quarter, with a consensus estimate for revenue of a little over $1 billion. A critical factor that could influence NIO's earnings is its margin performance. But will strong margins be enough to lift the company out of the red?
Let's talk markets right now as we kick off a new trading month and get ready for the jobs report later this week. Ed Yardeni is the president of Yardeni Research. And Ed, good morning to you.
Morning.
Let's talk a little bit about what we see post-earnings season. I think you point out that 98% of the S&P 500 have reported. Right. That leaves only 10 companies left. Pretty good time to take assessment of what happened and what we should expect for the rest of this year.
Well, all in all, I'd say that the results were better than expected. Coming into the earnings season, the analysts were looking at something like a 1 to 2% increase in earnings, S&P 500 earnings on a year-over-year basis, and it came in more like 6 to 7%. There's still a few more companies to report, but clearly a much better result. And we definitely are seeing that in analyst estimates of earnings for this year, next year, and in the following year. They've been raising their numbers. So all in all, this certainly justifies the bull market.
NIO has seen its consensus estimate for loss per share widened by 3 cents over the past 90 days. Despite this, the company's bottom line estimates suggest a 26.19% improvement from last year's period. In the past 4 quarters, NIO has had mixed results, surpassing earnings estimates twice and missing them twice, with an average negative surprise of 26.72%. In the most recent quarter, NIO reported a loss of 45 cents per share, which was narrower than the Zacks consensus estimate of a 51-cent loss and better than the 51-cent loss from a year ago. Additionally, NIO posted revenues of $2.41 billion, exceeding the Zacks consensus estimate of $2.29 billion and marking a 3.4% year-over-year increase, driven by higher delivery volumes.
Chinese companies facing regulatory challenges in the United States are setting up affiliates to try and protect their U.S. interests. While the actions to rebrand are legal, regulators are taking notice because they can't enforce the law if the owner or operator is unclear. Joining us right now is Riva Gujan. She's a director at the Rhodium Group, where she works with clients screening these Chinese companies. And Riva, can you explain in a little more detail what's happening? These are Chinese companies or extensions of Chinese companies that would be illegal, but these companies somehow rebrand and change what they're calling themselves, maybe some of their corporate entities, as a result to try and not lose what they've built up here. How's that work?
Yeah, and really no surprise there. As Chinese companies, as you described, they're trying to re-domicile, creatively restructure their entities as a way to stay sticky in supply chains, stay relevant in these friendshoring trends. And really, we saw a lot of this scrutiny pick up around 2020 or so, as Chinese companies, of course, were reading the room. They saw that scrutiny was building on them. And during the Trump administration, if you recall, lots of darts were being thrown at Beijing, right, and at Chinese entities. But there was still a lot of smoke in the room. And so there was still room, so to speak, for Chinese companies to try to rebrand themselves and hope they could fly beneath the radar. That's now becoming a lot harder, though, under the Biden administration.
Chinese companies are rebranding and setting up affiliates to circumvent U.S. regulatory challenges. While these actions are legal, they complicate regulatory enforcement by obscuring the true ownership and operations of some companies like NIO. This trend intensified around 2020 during increased scrutiny under the Trump administration. Companies are creatively restructuring to maintain their presence in supply chains and remain relevant, attempting to avoid losing their established U.S. interests by flying under the radar. As stated earlier, NIO's upcoming first quarter earnings report on June 6th will be crucial in determining its growth prospects. In the first quarter of 2024, NIO delivered around 30,000 vehicles, down 3.2% year over year. First quarter revenues from vehicle sales are forecasted to be $8 million, indicating a 4.3% decline due to lower deliveries. NIO has been plagued by high sales and general and administrative expenses for several quarters. This trend likely continued due to rising personnel costs and increased sales and marketing activities. However, there is a silver lining. NIO's gross margins have been improving. In the last reported quarter, Gross margin rose to 7.5% from 3.9% a year ago, thanks to lower material costs per unit. Additionally, NIO started delivering its 2024 models, which are expected to maintain higher margins and boost performance. Wall Street remains cautious despite a 14% rise in stock over the past month. Bank of America recently lowered its price target on NIO shares, maintaining a neutral rating. Out of 18 analysts on TipRanks, 8 rate NIO as a buy, while 9 recommend holding the stock. There are also potential tailwinds for NIO. What would it be? Before that, let's talk about the price target and rating of NIO. Moomoo's consensus rating is a buy with an average price target of $6.57 and a high of $10.40. Morgan Stanley is also rated as a buy with a target price of $10, while Citi and Deutsche Bank are both rated as a buy with target prices of $10.40 and $9, respectively. Moomoo's financial analysis presents a visual page of a company's net profit, growth cash flow, and dividend situation, helping you identify stable and profitable companies. It also provides dividend statistics and records, displaying dividend growth and dividend yield growth, which help you select high dividend stocks that have had stable and continuous growth. Furthermore, Moomoo's dividend calendar supports subscriptions, allowing you to quickly lock in dividend information and hold stocks before the ex-dividend date, making it easier for investors to take advantage of potential trading opportunities. Covered call strategy on Moomoo buys 100 shares of a stock and then sells corresponding higher strike price call options in the underlying stock without a complicated process. This strategy helps you generate income through premiums and provide coverage in case the option is assigned. Moomoo is also one of the lowest cost trading platforms available. It offers zero commission and no platform fees for stocks, options, and ETFs. After comparing fees, it has one of the lowest rates. There are no subscription fees, no minimum deposit requirements, and no account management fees. If you're a new user, sign up using our link and make a deposit to receive up to 15 free stocks, along with an 8.1% limited time APY on idle cash and a transfer-in bonus of up to $300. Don't miss out on these rewards. To make it simple, go ahead and just scan this QR code on your screen to get your 8.1% annual percentage yield only from Moomoo. That's it for today's sponsor, Moomoo. Now, the potential tailwinds for NIO. China's new investments in solid-state battery production could benefit the company, but the electric vehicle market remains volatile. Competition is fierce, with other Chinese automakers potentially scaling production more effectively. InvestorPlace contributor Josh Inomoto highlights the global electric vehicle sector's challenges, noting that while the market isn't deflating, it's slowing down. The affordability of combustion-powered vehicles for middle-income consumers further reduces the market for electric vehicles. Analysts on Seeking Alpha expect NIO's revenue to drop to $1 billion from $2 billion in the previous quarter. This decline is attributed to lower vehicle prices and a sharp decrease in deliveries from around 50,000 to around 30,000 in quarter one. The report's key figure to watch will be gross income margins. The last report showed a gross margin increase of 7.5% from 3.9% in the fourth quarter of 2022. An increase in margin, partly due to layoffs, could help boost the stock. NIO must also address its forward production outlook, having slashed its first quarter estimate. Analysts expect NIO to produce about 200,000 vehicles this year, a significant increase from the 160,000 delivered in 2023. Lastly, the threat of U.S. tariffs has recently cast a dark shadow over NIO stock. As shares rise on pre-earnings momentum, investors are left asking, is this former EV winner making a comeback, or is this just a fleeting bump? Comment your thoughts about this in the comment section below. Like other electric vehicle companies, NIO is also facing significant challenges in the coming months. Competition is heating up as companies from Europe, North America, and Asia gain market share. In relation to this, Build Your Dreams company just launched a new hybrid car with a 2,000 kilometers range. This comes at a time when demand for electric vehicles is slowing worldwide. A recent report showed China's electric vehicle industry will grow by 25% this year, marking its second consecutive year of slowdown. While this growth is still strong, the trend is concerning. The industry's most significant issue is becoming oversupplied, with most companies predicting double-digit production growth. Meanwhile, many Chinese dealers are struggling with massive inventories. NIO is ramping up its production and releasing new models. In the first quarter, NIO sold over 30,000 vehicles and continues to increase production. In April, the company delivered 15,620 vehicles, a staggering 134.6% increase year over year. It's too early to tell if NIO's recent stock surge signals a true bottom. That's why the company's financial results, which are due on June 6th, will be crucial, and every investor must look into them. Investors are likely finding it hard to have confidence in NIO stock as the earnings report approaches. The challenging market conditions and complicated geopolitical landscape have created a grim outlook for the automaker. Despite NIO's expansion into electric vehicle charging, it still faces a tough fight against stronger, trendier competitors. Will NIO overcome these hurdles, or is the recent surge just a fleeting moment? Share your insights in the comments below. If you enjoyed this video, you may also like our hand-picked, action-packed newsletter about NIO. Subscribe now at wiseinvesting.com. And that's it. Make sure to smash the like and subscribe buttons down below. Additionally, if you want to know about NIO stock, just click this video here. Thank you for tuning in, and stay tuned for more exciting content in the future.